Welcome to this introduction to Bollinger Bandwidth, an important volatility indicator used in technical analysis. To understand Bollinger Bandwidth, we first need to understand Bollinger Bands, which consist of a middle band and two outer bands. Bollinger Bandwidth measures the percentage difference between the upper and lower bands relative to the middle band. The formula for Bollinger Bandwidth is straightforward. Take the difference between the upper and lower bands and divide by the value of the middle band. This gives us a normalized measure of volatility, regardless of the price level, making it useful across different financial instruments. Higher bandwidth values indicate higher volatility, which often occurs during market breakouts or significant price movements. Lower bandwidth values suggest lower volatility, typically seen during periods of consolidation or indecision in the market. Traders use Bollinger Bandwidth to identify potential breakouts in periods of consolidation, helping them make more informed trading decisions. Bollinger Bandwidth values typically range from 0.1 or 10% to 0.5 or 50% in most markets. A low bandwidth below 0.2 or 20% indicates a period of low volatility and market consolidation. This often precedes significant price movements. High bandwidth values above 0.4 or 40% suggest high volatility, often occurring during strong trends or market panic. The absolute bandwidth values matter less than relative changes and historical context for the specific security you're analyzing. Remember that different securities may have their own typical bandwidth patterns. What's considered high for one asset may be normal for another. The Bollinger Squeeze is a key pattern traders look for when using bandwidth. It occurs when the bandwidth reaches unusually low levels, indicating extremely low volatility. This compression of the bands suggests that the market is coiling like a spring, storing energy for a potential explosive move. Traders watch for the bandwidth to begin expanding after a squeeze, which often signals the beginning of a new trend. The direction of the breakout isn't predicted by the squeeze itself. It could go either up or down. Bollinger Bandwidth is most effective when used alongside other technical indicators. Let's examine how different technical indicators complement Bollinger Bandwidth analysis. Volume indicators can confirm breakouts when bandwidth expands. Increasing volume during expansion signals stronger breakout potential. Momentum oscillators like RSI or MACD help determine the direction of the breakout. High RSI values suggest upward breakouts, while low values suggest downward movement. Price patterns forming during low bandwidth periods provide context for potential breakout directions. Watch for triangles, flags, and other continuation or reversal patterns. The 20-day moving average, which forms the middle band, can act as a trend filter. When price stays above the middle band, the trend is bullish. Below it, bearish. This multi-indicator approach creates a more robust trading system. By combining Bollinger Bandwidth with volume, momentum, price patterns, and moving averages, traders can generate higher probability setups with clearer entry and exit points. Let's explore how different timeframes impact Bollinger Bandwidth analysis. The choice of timeframe significantly impacts how you interpret Bollinger Bandwidth signals. Let's compare the characteristics of different timeframes. Shorter timeframes, such as 15-minute or hourly charts, show more bandwidth fluctuations, but these can generate more false signals. Medium timeframes, like 4-hour or daily charts, offer a good balance between signal frequency and reliability. Longer timeframes, such as weekly or monthly charts, provide more reliable signals but fewer trading opportunities. Here we can visualize how Bollinger Bandwidth appears across different timeframes. Notice how the shorter timeframe shows greater volatility and more frequent changes in bandwidth. Many experienced traders use a multi-timeframe approach when analyzing Bollinger Bandwidth. This approach allows traders to filter out noise and identify stronger signals by looking for bandwidth patterns that align across different time periods. Here's a visualization of how bandwidth signals can align across hourly, daily, and weekly timeframes. When all timeframes show similar bandwidth patterns, particularly contraction followed by expansion, it often indicates a stronger potential trading opportunity. Let's explore 3 effective trading strategies that utilize Bollinger Bandwidth. The squeeze breakout strategy is one of the most popular approaches. This strategy involves entering trades when bandwidth expands after a period of contraction or squeeze. You'll want to trade in the direction of the breakout, which is often accompanied by increasing volume. Properly setting your stop loss below the squeeze range for long positions or above for short positions is crucial. The volatility fade strategy takes a different approach by seeking counter-trend positions when bandwidth reaches extreme high levels. This strategy anticipates that periods of extreme volatility will eventually return to normal levels. Confirmation from momentum indicators can improve entry timing. Due to its counter-trend nature, tight risk management is essential. The range-bound strategy takes advantage of low bandwidth periods, trading between the Bollinger Bands in a sideways market. The approach is straightforward. Buy near the lower band and sell near the upper band. It's important to confirm range-bound conditions with other indicators. Be prepared to exit when bandwidth begins to expand, signaling a potential breakout. Whatever strategy you choose, proper risk management is essential. These strategies should be thoroughly tested before real-world application. Your position sizing should be adjusted based on current bandwidth levels. Always monitor for false breakouts and reversals. And remember to consider the overall market regime and trend when applying these strategies.